On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Hi team, trust you all had a good week. It was a very big one across financial markets. There was a lot going on, lots to talk about. So let's run through some of that and then let's talk about what is coming up in the days ahead. Very strong week for share markets in most regions. Confidence that interest rate cuts are just around the corner has been growing and markets have been responding positively. There was a lot happening on the central banking front. We'll run through some of the key events there shortly, but we did see the Swiss National Bank cut its policy interest rate on Thursday. That saw it become the first central bank of the G10 currencies to do that. And that followed the Federal Reserve's unchanged guidance for 3 rate cuts in 2024. So they left things alone despite some stronger inflation figures of late. And then we saw the Bank of England decision, which was the first since 2021, where nobody on the Monetary Policy Committee voted for a hike. So financial markets now expect interest rate cuts to come in the US, the UK, and Europe in June. It's only 3 months away. And for Australia and New Zealand to both cut rates in August, which is only 5 months away. So all of that saw markets move positively. We had the S&P 500 in the US up 2.3%. That's the best week of the year for the US market. The UK FTSE 100 rose 2.6%. European shares were up about 0.5%. Japanese shares up 5.3% last week. And that came as inflation accelerated. That's a good thing in Japan because they've had very, very low inflation. In fact, they've had deflation for a good portion of the last couple of decades. So inflation coming back up to near target levels, to more sustainable, stable levels is a good thing. We also saw the Bank of Japan hike interest rates for the first time since 2007. They were in negative territory. Now they're slightly in positive territory. Again, that's a good thing in the sense that it does put them in a more conventional position, and that's the end of some of that unorthodox monetary policy. Emerging market shares, a bit more subdued. They were up 0.5%, or just shy of 0.5%, I should say. They were dragged down by a fairly weak Chinese share market, which was one of the few to decline last week. Across the Tasman, the ASX 200 rose another 1.3%, while the local NZX 50 rose 1.8%. That was our strongest weekly performance of 2024. Interest rates down slightly. The US 10-year Treasury yield fell from 4.3 to 4.2, and the New Zealand 5-year swap rate declined 10 basis points, finished the week at 4.3%. The Kiwi dollar fell too on the back of that weak GDP report, which we will also talk about. That saw the currency fall against most trading partners, and we actually slipped under US 60 cents. So there's just 1 week to go until the end of the March quarter, 4 trading days in many markets because of Good Friday. And it's looking pretty good. I think investors will be pretty happy with how portfolios are tracking for those first 3 months of the year. Most share markets are up, some more strongly than others. And with the Kiwi dollar down this year against most currencies, in fact, all apart from the Japanese yen, some more than others. We're down 5% against the US dollar this year. We're down 4% against the British pound, 3% against the euro, and we're down about 0.75% against the Aussie dollar. So when you look at most of those major share markets in New Zealand dollar terms, you get some pretty good figures for the March 2024 quarter, 1 week out from those numbers closing off. So the local market is up 1.8%, Aussie shares up 3.2%, the US market is up 15.7%, 10% rise, and then sort of 5% of currency gains, so up 15.7%. UK shares in New Zealand dollar terms are up almost 7%. European shares are up 10.7%. Japanese shares are up 16.7%. And emerging market shares are up a little more than 7%, despite a weak Chinese market. So it's been a very, very good first quarter of 2024. Bonds are up too. Fixed income has risen slightly because we've seen interest rates come down a little bit. So let's run through some of the key events from last week, and we'll start with central banks because it was a really big week of central banking decisions, and the one everyone was watching for was the Federal Reserve, and this was out on Thursday morning last week in New Zealand. The Fed left interest rates unchanged, and it maintained its previous guidance that we would see three 0.25% rate cuts this calendar year. So the Fed's at 5.5%. That's the highest since 2001 in terms of its policy rate. And the next move is down. So it's really just been a matter of when is that next move and how many more do we see over the course of this calendar year. So June had been seen as the most likely timing for the first rate cut of this cycle, and last week's meeting firmed up the odds for that. So at the moment, markets are putting about an 85 to 90% likelihood of the Fed's first rate cut coming in June. And then the expectation is that you'll see two more rate cuts through to the end of the year. Fed Chair Jerome Powell in his press conference did err on the dovish side, and his comments did suggest that the inflation story hasn't really changed dramatically for the Fed, despite those stronger figures that we saw in January and February. So he didn't make any effort to rule out the possibility of moves, downward moves in interest rates over the next few months. So the market took that very well, and we saw interest rates fall, and we saw share prices rise. We had the Bank of Japan as well, and this was a real historic one for the BOJ and for the unconventional monetary policy of recent years. The Bank of Japan increased its key policy rate from minus 0.1% to slightly above zero. So that is the first rate hike since 2007. And that ends 80 years of negative interest rates. So that's a really important shift from the Bank of Japan. They also abandoned their yield curve control regime, which was introduced in 2016 and was aimed at keeping interest rates right across the spectrum lower, even for those longer dated maturities. So that was a real positive too. You know, it's a new era for Japan where we actually do have some inflation and more economic activity, which hopefully puts the economy and the financial system on a more even keel. They were the odd one out for a long part of the last few years, with those negative interest rates persisting, even though every other central bank has been moving away from those highly stimulative policies. So Bank of Japan, really interesting. We also had the RBA and the Bank of England. Neither of them made any changes, but we were watching the comments and what they said. And in terms of the RBA, their policy rate is at 4.35%. They last increased it in November. The next move is going to be down, and markets see a 40% chance of a cut in June, rising to 87% by August. So the RBA is expected to move in August. Inflation has been coming down generally in Australia. We will get some new figures this week, and it's expected to tick up ever so slightly from 3.4 to 3.5%, I think, but that's still much better than where Australian inflation was at a year or two back. So they've been moving in the right direction, and the next move is down, and it's probably a little later than the Fed, but not too much later. They'll be moving about the same time as New Zealand in the eyes of financial markets. The Bank of England, similar story there, no change, policy rate unchanged at 5.25%. And for the first time since September of 2021,
nobody voted for a hike. So that is really interesting, and I think that tells you where the committee's thinking is at. The next move will be down. Like the Fed, like the European Central Bank, June looks to be the most likely timing. Market pricing at the moment points to odds of a cut in June at about 77%. So we did get some more UK inflation figures last week as well, and these were good. UK inflation fell to an annual rate of 3.4% in January, which is down from the previous month where it was 4, and that's actually the lowest we've seen since September 2021. So that is all the news on the central banking front. You obviously also had that SMB cut as well. That was a bit of a surprise. So they have kicked off the easing cycle that is expected to start in other places later in the year. We had the flash PMIs for March, and these are economic indicators. I follow them closely. I think they're a really good gauge of where activity is at, and they pointed to a pretty solid global economy. Things started well in January and February, and they've continued in March. So the US composite PMI, composite means it encompasses both the manufacturing sector and the services sector. The composite PMI remained in expansionary territory. 50 is your break-even point, so above that means you're seeing an expansion. And for March in the US, it came in at 52.2. And if you look at the 3-month average, it's the highest we've seen since the middle of last year. So the manufacturing sector actually looked pretty good. That has been an area of weakness in the United States, but the manufacturing sector noted that production was growing at the fastest rate since May of 2022, which is almost 2 years ago. So maybe the manufacturing sector is starting to recover a little bit after a period of weakness. The European PMI improved to 49.9, very close to break even, stronger since June last year. Japan saw its composite PMI jump to a 7-month high, and the Aussie measure was the strongest in 11 months. So pretty good news in most places. There was some inflation indicators that were less encouraging, inflation picking up in some regions, which is something that probably goes hand in hand with that stronger economic growth. On the local front, we had dairy prices. More bad news, unfortunately. Dairy prices fell again. The headline GDT index was down 2.9%, so that's the second fall in a row, and the biggest actually since August last year. So most products fell. Prices are still okay. They're still up slightly this year. They're still about 24% above where they were in August last year, where they were in a bit of a slump. And pleasingly, Fonterra at its earnings release last week, which was actually quite good. It wasn't a bad result from Fonterra. They did reconfirm that the midpoint of their payout range for the farmer payout will be $7.80, and they narrowed that range as well. So that tells you that they've got more confidence, as you would expect, because the season is drawing to a close. So not too bad on the dairy front. On the GDP front, probably a bit more disappointing. We saw gross domestic product for the December 2023 quarter fall 0.1%. Markets were expecting a gain of 0.1%. The Reserve Bank was expecting no change, so a little softer than expected. That means the economy has contracted for 4 of the past 5 quarters, and that result is even weaker still when you consider the strong population growth we've seen over the past 12 months or so. In per capita terms, output fell 0.7% for the quarter, and it's down more than 3% compared to a year ago. So that definitely looks recessionary to me, and this has firmed up expectations that the OCR will come down. So markets see August as the most likely timing for a cut, and a rate cut is actually fully priced now for August. So what that means is that financial markets see that as a done deal. They see an August OCR cut as done, no question about it. So that is really interesting. There is a small chance in the market pricing that we could see a move in July, but for me, August would be a much more likely time frame for that to happen. Time will tell. Who knows what the Reserve Bank is thinking, and there's still a few bits and pieces to go between now and then in terms of the economic indicators and other data points, inflation figures and so forth. But at the moment, all signs do point to the OCR coming down within the next 6 months. So that is really interesting, and it has implications for investors. If you didn't listen to my episode the other day, then go back and listen to that one, because you do need to start thinking about how you position your portfolios for a slowing interest rate environment, or I should say a falling interest rate environment. Right, looking ahead, the key release this week will be the PCE inflation report in the United States. That stands for Personal Consumption Expenditures. This will cover the month of February, and this is the Federal Reserve's preferred inflation measure. So this will be in focus as we get close to that point where the Fed is expected to cut interest rates. Markets are expecting headline PCE inflation of 0.4% for the month, core PCE inflation of 0.3% for the month, and on an annual basis, markets expecting the headline PCE to slow to 2.5% and core PCE inflation to remain unchanged at 2.8%. So that is out, I think, on Friday. So we won't get it until we've closed up shop for the week. On Saturday morning, but it will be very closely watched overseas. We'll also get some early inflation measures out of Europe, and we'll get that monthly inflation gauge out of Australia, which I mentioned. This will cover the month of February, I think, and it's expected to sort of come in at 3.5, I think it said, wasn't it? Which is a little hotter than the 3.4 that we saw in January. New Zealand business confidence, that will be of interest. 1 o'clock on Thursday, the ANZ Business Outlook survey. February's edition saw headline confidence fall slightly. That was actually the first decline since April last year. But confidence generally, whether it's the own activity measure, whether it's the headline confidence measure, it's improved substantially from what we've seen over the last year or two. So we'll be watching how that is trending. We'll be watching the inflation expectations, pricing intentions, cost expectations, and we'll be looking at individual sectors. In recent times, retail and construction have become more pessimistic. Agriculture has become a lot more positive. Manufacturing and services have been sort of in the middle. So especially in light of that GDP report, which was definitely on the soft side, we will be keeping an eye on what this survey is telling us, because this survey will give us an indication of what's happening in the here and now. Remember that GDP report that got so much attention last week? It's very dated. It covers the period from October, November, and December last year. We're about to tick over into the second quarter of this year, so it is starting to look a little bit long in the tooth. We'll also get the annual budget policy statement, and that will kick off the process that leads up to the budget, which I think is due on the 30th of May, isn't it? That's a Thursday, so not too far away. So the budget policy statement will be released on Wednesday, and this is something that the government has to do by law, and they have to sort of present it to the House, I think 3 months prior to the commencement of a new financial year, which takes place on 1 July. That's when the new financial year starts. So they've got to have it done by the end of March. So that means it's got to be out this week. So it'll be out on Wednesday. It will state the broad strategic priorities by which the government will be guided when it prepares the budget. So you'll get sort of a high-level view of what they're trying to achieve. And it should include things like spending allowances it will work within, a bit of an update on the economic outlook, and a few other high-level issues. We're expecting personal tax cuts in some form at the budget. That was something that National campaigned on, so they will be presumably following through with that, and we'll be looking at how the borrowing program is shaping up and so forth as well. So it's not quite as busy a week as we saw last week, but it will be interesting. Last week of the quarter, so can markets hang on to all of these gains, or do we see a bit of weakness creep in? And obviously it'll be a holiday shortened week in many places with the Easter weekend break. So Friday is a day where many markets around the world, New Zealand, the United States, many other countries, the markets will be closed. So it'll be a 4-day trading week, and then we obviously won't come back until Tuesday next week either. But plenty to keep an eye on still, and hopefully we can see some of the strength carry through to the end of quarter. It will be very nice to see some quarterly reports from our fund managers or investment advisors that have some encouragingly positive numbers. So let's hope that some of the strength continues into next month. All right, thanks all. We'll talk again soon.